Hey everybody, happy Friday. Welcome to the Pulver Report. It is o'clock a.m. Eastern Time on the 23rd. This has been a pretty wild week. Sorry for the late start. Just kicking things off with the studio. The VRBO that I had this week, I had to temporarily relocate. And that was this morning since I'm going to be in the office all day. So anyway, hope everyone's doing well, and let's chat. So looking at the SPY, everything pre-market is down. Currency strength chart, the dollar made new highs. We've got the Swiss up here. The CAD, the dollar is coming back a little bit. Pound has been hit pretty hard this morning around 5:30 a.m. So we're just going to take a look at currencies, take a look at where everything is at. We had 4 central bank rate decisions this week. The Fed raised rates 75 basis points. The BOJ intervened. We'll talk about those levels on the Japanese yen. The Swiss National Bank did raise rates. They're now in positive territory for the first time since 2015, sitting at 0.5%. And the Bank of England raised rates as well. So the craziness continues. The path of least resistance apparently continues. The SPY broke 390, which is a level I talked about a couple of weeks ago. Said it was a critical support level, and it broke. FOMC on Wednesday went up and tested it and is rejected. So anyone that's been with me trading stocks, we've been doing bear call spreads and in the money bear call spreads. A couple of stocks, the SPY, and it's doing really well. We also have the VIXM, which is pushing higher. So we're hanging out here with some credit spreads at $33. It's really surprising that the VIX isn't really jumping. So this is your volatility index. It's up. The VIXM isn't really reflecting that, but nevertheless, still elevated. So SPY continues to look like we're falling. I would not be surprised if we start to target those pre-COVID highs, which is back around 340. We obviously can score a point here for the bears right around 360. With path of least resistance and momentum just falling to the downside of that 390 break. So pre-market's 370. That is, let's take a look at a futures dashboard on Market Watch. And everything should be pointed to the downside for some risk-off trading. So futures market this morning, Dow Jones futures down negative 1.1%, S&P down 1.07, NASDAQ down 0.91. Interesting that the Dow is actually leading to the downside. Usually that is not the case. Let's see here. Growling Powell causes Goldman to cut his S&P price target again. Let's take a look at the CME watch tool. This is some discussion we've had this week since Wednesday. I've had to look at this tool probably way that I care to, but it has certainly been a major catalyst really to where the markets have been going. Think about this. The Fed with low interest rates, growth orientation, accommodative monetary policy, stimulus, buying bonds, mortgage-backed securities for the last decade, that's the punch bowl. There's a saying that the Fed likes to take away the punch bowl right when the party gets started. So obviously we've had the party going for a long time. We've had probably one of the longest and most artificially engineered bear market or bull markets rather in the last 70 years. And really from the 2009 bottom in the stock market, up 14 years in a bull market to the bubble of 2021 to where we are right now. So we raised rates. We're currently sitting at 3% for the U.S. November is looking for another 75 basis points. That's the highest probability at this time. There was a shift by 25 basis points. This continues to change. Now, 75 basis points coming in November. That's what the market is anticipating. And then a 50 basis points hike in December. And then up to February and March, looks like there's another quarter basis points. So we're looking at a 4.5 to 4.75 peak Fed funds rate. Now, we don't know because we'll be going through, this Friday, we have one more week to wrap up the quarter. So Q3 is going to wrap up. The September effect has certainly been playing out as it usually does historically, which is a bear slide in the markets, and we're getting that. I am certainly curious to see with October if the market's going to start kicking into a Q4 rally or it waits until post-midterm, which would be early November, right? So we could have some more uncertainty ahead. We could see where, maybe there's a big shift from blue to red, U.S. politics-wise, and if that somehow lifts the market as some, unknown catalyst or some excuse to make the market rally to finish off a Santa Claus rally, I don't know. I did tell traders this, though. Here's what I would look for. Right now, path leads to the downside. Let's say the bears do score a point right here. If we come down to this level, might look at some capitulation right through this 360 level. We have our pre-high around 340. I am pretty bullish at that level. That's not a long-term bullish level. That is a short-term bullish level. So the bear score point, we find previous resistance from March 2020, and we rally to, again, can it make the market feel better if we don't close below the lows from here? Sure. If we don't close below this low, if we don't close below this low, and we somehow get back above here for Q4, I'm sure the market would feel like a sense of relief. Again, a lot of psychology and sentiment in these markets right now. Things are bad, right? Things feel bad. We're being told they're bad. The Fed is bad. It's just all these things are being projected into the markets, and it's weighing on sentiment big time. And so everything is just eroding. This week in Equities on Demand, we literally looked at a screener for consumer defensive stocks. We have 17 stocks we looked at. We started taking trades on Unilever, and there's a couple that we just set a bunch of chart alarms. I was assigned overnight on KHC, which is Kraft Heinz, which is a stock I don't mind owning, but I want to see where it's at. I mean, my expiration was 10/21, so I'm getting assigned a month early, and I don't particularly love that. So what I could do is nothing. I mean, I could see how bad this gets over the next 3-4 weeks. If this gets, this is, like I said, this is a stock I don't mind owning. If we come back to this low, or we come back to this low, I could still use that long put to my advantage to own Kraft Heinz in the low 30s. Would I own a stock like this in the low 30s? Yes. Past resistance becomes support. Let's see if we can hold here and stabilize right around current price. The flip side of that is broker assigns me when I'm still holding the long put. If price comes back up above my strike price, this was my expiration right here, 10/21. It was a 40 by 37.50. So my 37.50 right now is going to be worth about $3 and change. Could I let it get up to maybe $7 or more? It's very possible. I have time to figure out if I want to keep the stock or not. This is a decent defensive play. Made some pretty good money on Kraft Heinz on this rally and this rally, and either we get that rally again or we come down a little bit deeper and lower. One thing I want to be careful of on this stock is, do I have enough time? And again, I don't have to own this stock forever. I mean, if I'm not convinced that, oh man, it doesn't seem like the bottom is in, if I'm concerned that this is where the bottom's going to be, I can still manage my long put down to this level, close my shares, and end up losing about $1.25 on the trade, which is what my initial risk was anyway on the trade. So with some options, we can manage our risk pretty well. But if we hold this level right around $33, $34, that's fine too. So it was assigned overnight, which I'm noticing that's happening on some of these stocks. Is I'm a month away from expiration, yet the broker's still assigning me. Really quickly, let me log into YouTube and see how everybody's doing. So youtube.com/Chris Pulver. I know this has kind of been an odd week. I've been traveling. I'm in an office in Utah, so getting adjusted to mountain time, big difference. And then this morning I was thrown off. I forgot that. Hang on a second. I forgot that I have a temporary displacement for 3 days with the place that I'm staying. So it's fine. It was just an inconvenience for me. All right, here we go. Morning, Wayne. Good morning, Gary. Herbert's here. Daniel, what's happening? Steve, good morning. Jason, good morning. Perry's in the house. Good stuff. No Santa Claus rally. Yeah. Santa might be just making some lithium for everybody. Catherine, good morning. Nimmer, what's up, dude? How are you, man? Nice to see everybody. So KHC was assigned Santa. Look, I'm telling you, I don't know if it's going to feel like a Santa Claus rally. I think it's more of like the market just wants a little relief. But here's the deal. I'm making money on the way down. I have 3 bear call spreads running on the SPY. And as I think I did the math yesterday, it's worth around $8 in credit. So that will help me make some money on the way down. And I want to make sure that I'm protecting those profits. We have these pre-COVID highs, which I think is a decent spot to look for a bounce in the near term. And I'm not going to get aggressive with ownership necessarily. I'm going to get aggressive with call options probably. Between credit spreads and call options, I'm still going to keep most of my stocks and options portfolio option heavy. Reason why: easier risk management, easier hedge, protect yourself both ways. If we find a bottom, great. If we don't, then we're protected to the downside. We can take ownership of quality stocks at prices we want. So that's what I'm looking at for stocks. Equities on Demand class will be at the top of the hour. Coming into Forex, let's look at the currency strength chart for a moment. Let me go here. So we have Swiss and dollar. We have pound getting beat up pretty badly. Again, high volatility this week. Yesterday, big intervention by the Bank of Japan. And Swiss, like I said, raised rates, but still, massive move to the downside. Swiss yen was a 600 pip candle or an 800 pip candle. Let me check. It was ridiculous. It was up to 151 down to 143. So I think it was close 700 or 800 pips, which is pretty nasty. So here's Swiss yen. We're at 146 right now. So big indecision candle. And I had a little discussion yesterday with some traders. So Market Traders is running this Mind Over Markets event this week. And I just shared a little news candle strategy. And I think we're in a lot of these trades right now in the Japanese yen. Because of this big intervention candle, what I'm looking for is this. If price breaks and closes lower, measure this move right here. So this high, this low, and project that move to the downside. So right here, I'm just going to take a box. This is pretty simple. So you take a box and trace the move. Okay? Trace that move. And then you copy and paste it. So if we break to the downside, there's your projection. We break to the upside. There's your projection. So if we are, market neutral, if we're market neutral and we're position neutral, you're just looking for price to break out one way or the other. If and when price breaks out. Now, remember, we could spend days inside of this massive candle, right? We could have today looks bullish, but it doesn't break the highs, doesn't break the lows. We could have several days inside of here. But if and when this breaks, and it's obviously not going to stay here forever, it's going to break eventually. And a really easy strategy on all of these Japanese yen pairs is if it breaks higher, look for that breakout. That's your projected target. If it breaks lower, there's your breakout. That's your projected target. Okay. So the good thing is I guesstimated, and I was kind of conservative on this. I just said that, okay, every currency pair yesterday for the Japanese yen, and some of them are higher than this, roughly every currency pair was around 300 pips. Okay. Now some were bigger. This was like 700 pips. The dollar yen was like 500 pips. There's been some big movements, but let's say that all Japanese yen pairs had 300 pips of movement on this candle. Well, if that's 7 currency pairs, okay, what's 300 pips of a breakout opportunity times 7 currency pairs? It's 2,100 pips. So that right there is a pretty good near-term opportunity once we see some confirmation above or below, right? As far as the stop loss goes, this is a trade that would require stop loss. If we break above the highs, you can look for a tighter stop loss with a breakout, or you can look at the halfway point. And that's usually what I do is I'm a little bit smaller on the trade size at first, but I look at a halfway point. So if it breaks to the downside, halfway point's my stop. If we have a nice little push to the downside, move your stop loss to break even or better. Same thing to the upside. It breaks to the upside, get up 50 to 100 pips, move your stop loss to break even or better, and run with that to the upside. So there's some pretty good opportunities on these JPY pairs. All right. Let's take a look at the other crosses. I want to go through JPYs really quickly. Is that cool? Morning, Donna. How are you? Nice to see you. How is everything coming through, by the way? Is audio fine? I've got a microphone and stuff set up. I'm still waiting on a couple of attachments to get a third monitor, but I'm doing what I can. Hopefully it's coming through loud and clear. All right, Aussie yen. So here is that daily candle, right? Here's our big daily candle. Again, we didn't break the lows. If we do break the lows, that's around 93.60. KO. So Coca-Cola's heading down. Halliburton heading down. All right, so Wall Street's open. It's going to be a pretty red day, but guess what? I'm bearish on the SPY and long on volatility. So that's good for at least my hedge. And then I'm in pretty much 85% credit spreads. So we'll, that KHC, I might just leave it open because the expiration's out to the 21st of October. So I have time. I don't mind owning that stock. It's consumer defensive, low volatility compared to the market as a whole. But I certainly want to own it. If I'm going to keep it, I want to own it at a very, very cheap price. All right. Anyway, Aussie yen, there's your high around 96.40, and there's your low around 93.50. So like I said, about 300 pips. If we get a close, all I'm looking for is, a 1 hour or 4 hour close to just look for a simple breakout. And if this is in fact a rising wedge, project that move just based on the indecision candle, but also you can target this low and target this low. And really, if this truly is a falling wedge, we might be coming all the way back into here. Right. But again, I think the yens are very slippery. And, if we have a nice breakout and a straightforward, awesome, trade it. Right. But what I'd like to do is if we have any stop losses in, eliminate that risk and trail it. If the market's going to push and pause and push and pause and give us some bear flags, I'd like a trailing stop loss to just be sitting here. Price goes lower, it trails. Price goes lower, it trails. Right. And just stay with it. And if I get knocked out with a 50 pip trailing stop loss, that's totally fine. So I'm going to look for entries like that. So that's Aussie yen, CAD yen. Again, same thing. Here's your big indecision candle. That breakout to the downside would be 104.50. I would target this level around 101.70. Again, you can measure that. Probably comes back down to this area. There's a nice 200 EMA and some nice structure in here with some pivots. But that would be if it's a rising wedge, something like this, you connect these highs, okay, connect this level. We've broken this. We should be pushing to the downside. Okay. So I think CAD yen looks pretty solid. If we break that low, I'm going to set a chart alarm right there at 104.60 and look for that breakout to follow along with some trades. So 104.60 breakout lows. That's CAD yen. Swiss yen, we just did that one. Euro yen. Euro yen, it's testing the low. Large indecision candle. The high at 143.70. The low at 139. We'll say, it's over 400 pips. So if we break that level, that's 138.60. And looking for a breakout and some follow through. Euro yen, pound yen. Pound yen's already made the breakout. So in fact, traders with me in the flex room, we were short on the pound yen at this resistance, and we had a sell stop order that took us all the way down into a nice pocket trade prior to the BOJ on Thursday night, or Thursday morning, I should say. So we already grabbed some pips right here, but the pound is coming all the way back down. If anybody's short on pound yen, that's fantastic. I think this is a decent level. But at this point, if you shorted any of this structure or any of this recent move, trailing stop losses, be in profit, we've had pretty much a straight fall for, 700 pips. So we come back to 156, or we have a falling knife all the way back down to 151. I do like the idea of maybe picking up some short-term buy trades at one of these levels. Just be very careful. I think if I'm going to choose, I'd rather buy it at 151 or 150 than trying to do something right now. I think there's still more room to the downside on pound yen. But the whole point is we sold it from the highs, and you're in great shape in this one. New Zealand yen was another one that's cooperated really nicely. We sold this one at the highs at 87, 87.50. It's down to 82. So 400 to 500 pips to the downside. Working out beautifully, protecting profits, trailing stop losses, all that good stuff. And then the dollar yen with that massive indecision candle. We see green on the day, but still an inside candle. So watch the high, watch the low. I'm looking for a breakout below 140.40. Looking for breakout. Okay, and there's also a massive bar count on the dollar yen with the daily time frame. It's 412 bars, which is crazy. Again, doesn't mean this is a moving target. We can just consolidate here and this moving target can catch up. But I'm still looking for, this area to kind of hold firm at 145 since the BOJ was willing to intervene. But we might see, I don't know, some crazy move up to 147.50 or 150. That's kind of my fear. No, but no, I've prepared for that. I've got level scaled in at 147.50 and 150 just in case. But otherwise, we're watching the dollar yen like that. Okay. All right. Good stuff. Yeah. So watch those levels, set some chart alarms on those JPY crosses. Let's go to the dollar index. Chart alarm went off at 112. Here we go with a new fresh high on the dollar. We're chewing into that big supply zone from 2001, 2002. The market just seems to love the dollar for now. Now, again, how much higher or lower does the dollar push? Just look left. We're in a 14-month trend since the lows in May. We're in an 18-month trend since the bottom of 2021. It was January 2021 when the dollar bottomed, and this thing has been ripping ever since. Now, I still, and again, maybe I'm clearly early on this idea, right? But if I'm premature, that's okay. But how I manage this trade is what's important. This level is really key, and we're clearly eating up some of this supply right now. So if this resistance, which is around 115, that could hold, but we also could see the type of capitulation that gets us up into 120, and then this dollar just makes an amazing fall from grace. So I still think the technicals will line up. I just think this has been a very stubborn, irrational trend that's lasted longer than I expected. But again, that's how I played it. Some traders have been long the dollar, are loving it, and it feels like the easiest trade in the world just to be long the dollar. So good. I'm glad. I'm happy for you. I am not long the dollar at this point. I think I'm starting to see falling wedges and rising wedges, and I'm looking for tops and bottoms. But I realize that as we head into Q4, unless we see a bottom in equities, we're probably not going to see a top in the dollar. So you want to play a correlation. If you're looking for bottoms in equities, you're going to have to look for a top in the dollar. Obviously, when you're trying to pick tops and bottoms, that can be very difficult. Okay. So looking left on the chart, I could see the dollar at 112 making highs. Either we stall right now, which doesn't really seem to be the spot, but 115 is a number I would write down for potential resistance, and 120. And how do we get there? It might be just a stubborn, crazy flood all the way into the end of the year, because it's like, you know what? The Fed's going to keep tightening, so the market keeps loving the dollar. But at some point, the dollar turns. That top in the dollar will likely lead to a bottom in equities. And I will be ready. Okay. So the point is, keep the trade sizes under control, keep the risk management under control. And, favor some dollar. I'm not short the dollar on everything. It's like I could be short Aussie dollar. I could be long. I'm starting to think I could be short Aussie dollar. I could be short New Zealand dollar right now. I'm currently long dollar Swiss. I took some profits, but I'm still holding partial positions. So I have some dollar exposure that's benefiting from this. But I also have, pound dollar long, euro dollar long that I'm sitting in and just kind of waiting for some turns. But we're at some fresh lows, right? I mean, weekly time frame, fresh lows, divergence already printed. We're oversold on the weekly. We're oversold on the monthly. What are you going to do? I mean, how much lower does this thing want to go? Look at the monthly chart. This looks similar, right? 2000, 2001. Does this not look exactly like the inverse of that DXY? This level right back in here, these major lows, that's right around 90 to 85. Could we stretch that far? Sure, I guess. I mean, it's like, what's going to stop it? Are we dropping another 700 pips? Maybe. Are we dropping another 1,200 pips? Maybe. But if we do, I'm going to take this thing back to 105. And it's just, if I can hang on and survive, and if I have to take some small losses, I'll get the shift. But when and if I get that move, I mean, I'm going to be pretty aggressive on dollar weakness. I just need to see it confirmed. That's my missing piece right now, is confirmation. So I'm anticipating bar counts are extending, but that is what we're seeing. The path of least resistance is dollar strength. I just think if you're position trading dollar strength right now, you're silly. I think if you're scalping dollar strength, that's fine, because we're getting these pushes and the market's still running. But I couldn't justify just holding dollar long forever. It's like, get in, go to a smaller time frame, trade with some precision, and you can probably grab 30 to 50 pips, eliminate risk, and let it run, and maybe have a runner that gives you another few hundred pips, right? So oil just broke the lows. Okay, let's take a look at oil. Oil at 79.16, really interesting. Well, I mean, in a way, oil breaking lows, commodities breaking lows, everything's selling off. It's probably a good thing for CPI. I'm not going to lie. It's probably a great thing for inflation to see oil heading lower. I think there was a major concern, and it's still out there. There's a major concern over the next couple of months that, what about demand? I mean, look, if China comes back online, there's going to be demand for oil. But I just feel like right now there's so much negativity that's being tossed into the market that it's like everyone just is bracing for the worst case scenario. So yeah, I could see, the SPY is falling, oil's falling, dollar's the only thing that's really reflecting positive, right? Because that's your safe haven flow. And again, that seems to be the current direction. So like I said, oil falling lower is probably a good thing for CPI. We will still be, month to month, which is crazy annoying. Also with the Fed, we don't have an October rate decision. We have maybe the FOMC minutes. That's it. So we will obviously wait and see what CPI data gives us. There is a chart right here for year-over-year inflation. If you do the year-over-year inflation, we're sitting at 8.3. Remember the high at 9.1, 8.3 is current. We had a tick down to 8.5 and then 8.3. If we're seeing oil dropping, remember, the biggest contributor to this headline inflation was energy and food, right? So if oil prices are coming down, if gas at the pump prices are coming down, energy and as a whole is coming down, we could see a decent trend to the downside. And again, depends on how excited the market gets. Is the market going to be excited about headline inflation or year-over-year headline inflation being at 7? Is the market going to say, well, it's trickling lower, it's trending lower, we can go ahead and start pricing? I don't know. Maybe the market's not willing to price stuff in. Maybe the market's not willing to price anything until CPI is down to like 5 or 4% to match the Fed funds rate. I mean, we're clearly in a very odd situation. Even though the market is always forward thinking, it doesn't seem to be anticipating any optimism right now. So I'm not trading optimism. I'm trading pessimism. I'm trading negativity. I'm short the SPY, and so far it's working out great. But it's not my permanent position. I'm not a perma bear. It's like I'm bearish for a reason, but we have gaps to fill. And if the bear score a point here, great. Bear score a point, take some profit. My expirations were November, December, January, March. So I'm way out here, just like, I'll give myself time in these bear call spreads. So I'm not going to collect the full profit, but we've already made a run pretty quickly where I'm going to try to collect as much on that as I can. And also mega tech. You look at your major tech like Apple. Apple's at 150. I've got a 140 by 145 bear call spread. So that's in the money. It was already profitable yesterday, and I'm not even close to strike prices. So if we come into this, 140 by 145, I might be able to grab $3 and change out of this max 394. So there's some decent money to be made on the downside, which is what I'm playing right now in the short term. Everything else is just holding, majority options, credit spreads. So that's that. So play in equities, stocks and options. Options are great. Heavy options right now because I want the flexibility. Currency wise, it's all about the dollar. You have to know those big levels. You're at 112 right now. Why is the dollar going to stop at 112? It's probably not. It's probably running up to 115. I have chart alarm set at 113, 114, 115. We're probably running to 115. And if we get this crazy, stupid capitulation move, we're probably going to 120. Right? I'm just telling you, I'm warning you that if we run to 115, what does that do for your currency pairs? Okay, 115 would be a great rejection, but I think 120 would be even better. So again, I might have to take some small losses on euro dollar. I might continue to ride my dollar Swiss long. I might look to get some fresh shorts on Aussie dollar and evaluate, but I will do my best to be positioned. I'll share this with my flex traders and, we'll talk through it all. So that's trading. See, one thing I've learned is extremely difficult to outsmart institutional traders. That's an interesting point. So this is a year that we've really seen the herd be right. So think about that. Like the commitment of traders on the dollar index has been high probability long or percentage long, like 85 to 90% long dollar index. That herd has been rewarded, which is great. Okay. At the same time, you have the herd that's also short dollar yen. So that makes me nervous that the contrarian side is like, well, the dollar yen is going to keep, pushing higher, but you also have a backstop, at least temporarily, for the Bank of Japan. I don't trust that. I don't like that. I don't want to rely on the Bank of Japan at all, because what they've created was some of the dumbest moves we've seen in a long time. But we are seeing, money flowing, and I'm trying to make sense of what this means in the bigger picture. If this, again, I'm looking at the charts. I could speculate if I'm using opinion, but I'm trying to look at the big picture. I understand why the market is flooding with dollars, right? The dollar right now is arguably the best safe haven, and it's a central bank that is, has one of the better track records with one of the biggest banks essentially, and interest rates are rising. So if fixed income is looking for a place to go, if inflation is going to improve, that gets better. But I think the hard part right now is, money's flowing into the dollar. Fixed income is still losing to inflation. Oh, congratulations, you got a 3% bond, but you're 8% inflation. It's like you're still losing and parking cash. But the problem is, equities and bonds are not great. Yields are up, but bonds are still down. Equities as a whole is down. And it just is like you're getting safe haven flows. So here's my conclusion. The dollar, if it stretches to 115 or 120, I think it's going to look a lot like this. I do think that at some point, we will have a wave structure. You can't go from this level to this level straight up and not have a pullback. So even if it's this, right? Even if it hits, 115 and then gives us like some type of rising wedge or gives us a 3-drive pattern, when we reverse, we'll have a 1, 2, 3 wave move. Now, whether it comes all the way back here remains to be seen. Maybe it comes back here. That's a nice little pullback. That's a nice efficient move. We have this low, we have this high, and we pull back halfway. That would be perfectly balanced. And the Forex market does that. Currencies do that a lot, right? We could also have this top and it completely resets. I don't know, just like it did here, right? When we had that growth coming out of the dot-com bubble, we went for 6 or 7 years with a crazy weak dollar until we bottomed after a financial crisis in 2009. So, I'm just looking at the charts. I think that the dollar's long and it's overstretched, but it doesn't seem to be stopping. Breaking these highs and having this open space doesn't make me comfortable. So I will be managing my risk accordingly. Everything I look at technically in the way I've traded for years, I look for extreme conditions. We have it everywhere, but it doesn't mean it has to stop right now. So I'm just, banging the warning sign or banging the warning drum. Don't call the top. Don't call the bottom. If we're looking for a bottom, I'm looking at equities. Where would that bottom be? Previous lows from June, pre-COVID highs from March 2020. So between 360 and 340, protecting your downside, right? Meaning like if I'm bearish, which I am, protecting my profits in that window. Okay, protecting profits in there. Anywhere in that window, I'm looking for buy opportunities. Ideally, I'd look for them at these pre-COVID highs because we'd have a fifth wave move. It doesn't seem to be that difficult when you look at it. High to low, lower high to lower low. Let me zoom in. Hang on. That's weekly. Let me go daily. And then I'll wrap things up here in just a minute. So it's not that difficult, right? High to low, lower high to lower low, lower high to lower low. Does that seem hard? No, that's a fifth wave move. So do we get there? Sure. Do we capitulate further than that? Maybe. But if this is just high to low, lower high to lower low, lower high to lower low, protect your profit, I'm looking for a bounce. Again, the way I trade this is mostly options. The way I trade this, if we get a bounce in equities, look for a top in the dollar, at least in the near term. Okay? So that's how I think the timing of this plays out. I don't know if that's this week, next month, end of the year, Q1. I don't know. The way it's falling right now, it seems like we're going to be at this June low pretty quickly. If we fall further than that, okay, fine. What do? We're protecting profits if you're bearish. I'm looking for a top on the dollar, and that's it. I'm looking at price action. I'm looking at the charts. I'm not going to speculate on what the Fed's going to do, right? Jerome Powell, if you listen to his press conference on Wednesday, he won't tell us where the rate's going to be. He says the Fed wants to keep everything restrictive. They want to restrict growth. They want to compress consumerism. And again, not to tank the market intentionally, but they need to squash inflation. And so to do that, their narrative is very firm. And again, maybe it's partly jawboning. I don't think the Fed wants to be anywhere near 5 or 6% interest rates. They don't. Every 100 basis points is $300 billion of debt service. That's unsustainable. We're going to be at 4% plus by the end of the year. So the market says that's over $1 trillion added to debt service. I don't think the Fed wants that. Nobody would want that. I mean, we can't even fathom what $1 trillion looks like, and it gets tossed around in the global economy like it's nothing, So I think there is an interesting game of chicken going on between what the Fed is saying, what the Fed wants, and what inflation is willing to do. And the problem is inflation data only comes out once a month. So, that's the stuff we're watching. All right. Anyway, I'll go and wrap it up there. Class at the top of the hour for Equities on Demand to finish up with some stocks and options this week. Next week, it will be more business as usual since I'm a little bit more established in the office here. So come back and join me at 9 a.m. on Monday for weekly outlook and Friday recap. And let's see what we get next week. Next week is also the end of the quarter. So the 26th through 30th, we wrap up September. Is the September effect going to end on a sour note? Probably. How does October give us a bounce? Do we get a bounce? Is it Q4 time? October to March, traditionally, historically, is the most bullish time in the markets. Doesn't mean we're getting it right now. We also have a midterm election that's also throwing things up for debate. We'll find out. Is it a big red swing? I don't know. I don't really care. I don't know. We'll find out. So anyway, that's that. But if you do me a favor, everyone watching, click that thumbs up button for me. Please support the channel and have a great Friday. Have a great weekend. See you back here on Monday. Okay. Thanks. Bye.